Okay, hello everybody. I would like to welcome you to my group. This group is for Trading Forever members. Why Trading Forever? Trading Forever is basically I'm targeting people who are willing to trade or who are willing to understand Forex forever. Like they're in this thing forever. They're not here to trade for a month, for 2 days. They already understand it's forex trading something when you want to do it, something you should tell yourself, I'm going to do this thing forever. Because that's the only thing that's going to push you to improve. Because if you're not willing to do it forever, it meaning you already have like your certain time frame. Maybe you say I want to do this thing for 2 years, and if that 2 years reach and you're not satisfied with the results, meaning you're going to give up. Yet people who give up in forex are the one that they think forex is a get rich way scheme. They don't want to learn. They don't want to. They always want the shortcut in forex. Those are the people that they are not sure whether they want to be a trader or not. Here, I'm looking for people who want to be traders, and they are here to master the art. So, why I'm sharing this information that I'm about to share, I'm sharing this information to help people and also to help myself, because I've been trying to help people, but what I've discovered, many of people they don't want to learn. Many people they don't want to put in the work. So forex trading is a very hard thing. In the beginning, I thought it was easy, but I then understood that this thing is very hard. It's even hard to find somebody who's going to show you something that is legit, even on the internet, even in person. So please take this opportunity and try to master what I'm going to give you, because I know what I'm going to give you is something that's going to help you. Whether you already have your own approach to the market, or you are looking for some approach to the market, but this is the only approach that will be clear to you, less stressful, and then from here you'll understand how the market moves, because I'm going to teach you the market structure and then the liquidity. So the market moves in structures and trends. So it's either the market is moving up or the market is moving down. But the market, before it takes a major move, it can move, but there is a major move. A major move is a move that is high momentum. So this major move usually they occur after the market takes out liquidity. So being so, it's better for you to wait for the market to take out liquidity, because when the market takes out liquidity, at least it got a high chances to move, like a large movement, I can put it in that way, or a trend reversal that is valid, to say so. So trading forever QM is a strategy I've developed after I've tested a lot of strategies. Like I know a lot of approaches to the market. I've tried a lot of approaches to the market. I know approaches that work 50% time. I know approaches that work 60% time. But now, out of all these approaches I've tested and I've used, this one outstands. Okay, let me just try to illustrate a bullish example of what I'm talking about. As I illustrate this example, I'll try to explain like almost everything I know. People who are in the group, this information is likely to be sold. So, but like I don't want to be a mentor anymore to say, like, put it like that. It's something that is very stressful. So this information, I'm trying to code it into a QML indicator, almost like 60% with the job of coding it, and then I'm going to run it, and then at the end of the day I'm going to create a trading software, like an expert advisor and a robot that people say most people they are a robot, so they can something that will do this thing automatically. So when the project is 100% done, people in this group will be the first people to know. But I don't want you to have that programs without you understanding what the program is about. So if you're going to use the robot or the indicator, you'll be better, you'll know what the indicator is about, where it's derived from. So unlike taking an indicator robot, you don't even know the strategy behind it. So now I'm giving you the strategy that I'm coding it into an indicator and a robot. So I'm gonna make a bullish example of this setup. So first thing first, when you open your chart, you will observe the last price, the current price of the chart, and then you will look for swings. So the trends, and whether the swings will determine whether the market is moving down or is moving up. For example, for a bullish example, you see something like this: a swing high. The swing high is being broken, and the market forms another swing high, breaking it. So when the market prints the price like this, it will definitely mean that the market is moving up. So, and this information you can search them on Google and find PDFs how to find the trend. So basically, this is seeing how the current trend in this case, it's a bullish trend. So what you do then, you just try to analyze the market or try to observe the market. You can mark your highs. But as marking your highs, you mark these lows too. So let's say the market continue making a high. You'll mark the highs. Either you mark them physical on the chart or you mark them in your mind, because once you get used to this, you don't need like to mark everything. Something you can see in your mind. Okay, this is a high, and just have it in mind that there is a current high here. So the market, after making the highs, the high highs, it will eventually showcase the market whatsoever trend. That trend need to be reversed. So right now in this uptrend need to be reversed and the market start making a downtrend. So what you looking for is a change of character. The change of character meaning it's a change of trend, that you are changing the current trend to another trend. Since you know we have two trends, uptrend and downtrend. And if the market is uptrend, you're gonna change from uptrend to downtrend. So how do you spot that change of the trend? You wait for the market to come back and break this low. They break this low. This low become a change of character. And this information that I'm giving you right now is widely on YouTube. You can even search how to spot change of character. You'll find something like this. So after spotting this change of character, many people or smart money traders, they know that okay, the market is changing. What you need to do, you need to find a point of interest, a point where you are looking to take sales that will go against this uptrend. But that's the tricky part. It's hard to spot where the market will sell after changing the current. And even though it's hard, it doesn't mean when the market changes the character, the market is really going down. Sometimes you can change the character and continue like rally up with the movement. So that's why when something happens in the market, you need to have confirmations and have a lot of understanding that it's likely nothing is certain in the market. That's why we analyze. That's why there's risk management. Risk management means there is nothing certain, but whatsoever happens, you don't bleed that much. It's something that you can take, something that you're willing to lose. Because if there was something certain, we wouldn't even use stop loss. So the stop loss and the risk management is proof that nothing is certain. But what you are always fighting to do is trying to be right in most cases. If I'm going to trade like 10 trades, I'm fighting to be right on 8 trades, at least be wrong on 2 trades. In overall, I should be above the margin of being profit. So after spotting this trend, the uptrend, you can spot that the market breaks this point, meaning is reversing. Let me try to draw a clear illustration before I continue. We have something like this. Change of character. The market was moving up, but breaking here, it means the market is now changing the character. So when the market breaks here and change the character, we have this high, the last high, the higher high, and that higher high is the last price, meaning the last price. I'm not talking about a reaching, I'm not talking about an order block. When I say the last price, I'm talking about the last week. You see, usually there will be a week on top of the week where the price ended, the last price, that's the last price, because price is not like reaching. Prices mean like literally the market printed here from here to here. So after changing of character, we look for the higher high, the last price, and that higher high is going to be a point of interest, meaning that from now you do nothing at all. Besides waiting, what are you waiting for? You are waiting for the market to come back and touch that higher high. Why does the market touch that higher high? The market touches that higher high for different reasons, but for us, we want the market to touch that higher high because that higher high is a liquidity. So the market needs to sweep that liquidity and then continue going down. Why the market is looking to sweep liquidity of the high high? The market is looking to sweep liquidity of the high high because most people, once the market changes the character, they will have the order block here reaching, and this order block, they will mean the market will need to come and sell here and continue. So this is a smart money approach. So since smart money people, they are different from ordinary traders. Smart money is more like these traders with some knowledge of how to trade the market in a smart way. So they're trying to like eliminate a lot of risk. So they usually trade these order blocks and fair value gaps, things like that. And then when they spot a change of character, they have this reaching. See, this reaching is almost close to the last price. It's the last order block. So last order block, it's better to trade on last order block rather than to trade anywhere in the mix. So smart money people, they will say they want to sell here, but the market knows everything. The market knows everything. Everything you know, the market knows. If the market was a person, this statement can be literally true. But the market is not a person. However, the price, or there is a thing I'm not sure if many people know. The price on the chart is controlled by human behavior. There is no one who controls the market, literally one person. But how we behave is how the chart behaves. So what we know, we react on what we know. Many people, they know, okay, the market will be, when it does like this, it do like this. So when people enter and everything, so the market just reacts to that behavior of human beings. So basically, if you want to understand the market or understand liquidity, understand that the price is just a human behavior. So human behavior knows that if the market is going down, eventually the market will go up. Big institutional traders, they say buy the dip, because if the thing is going down, eventually it will go up. And here we're trading assets, whether the the currencies or whatever you see on the chart, you can create an asset, and all assets, they need to gain value. So meaning everything that is on chart, the goal for it is to be bullish. Yes, in reality everything goes up and down, but what we hope for, or the owner of that asset or that business or that country, we want the country to make money, we want our business to make money. So eventually at the end of the day, the mindset of everything is bullish. To come back to this setup, you remember I said smart traders sell here. So smart traders, when they sell here, they will be like, no, we are smart traders, we are not like the dumb traders. So our entry is better. Most people will have confidence, leading them to increase the lot size and everything like that. And then the market will come back and take out the stop loss because of traders. Because the stop loss of smart traders, they've put the stop loss above the higher high or on the higher high. The market is take the stop loss, and then when they might take the stop loss of these people, the stop loss of people will give the market a lot of money, because the stop loss of people will be the liquidity. So when the market takes out the liquidity, it will drop, then start continuing. So the stop loss is more like a fuel to the market. The market needs to make money from our stop losses, and for it to have a momentum to move. So I'm not sure if this video is that helpful as I think, or am I that clear as I think. But this video, I will share it as it is right now. Getting feedback from you will determine how it should like give you the information. Then your feedback will determine everything from now. But right now I was trying to give you the understanding of why this strategy you should focus on it, or why you should stick on the group, so that you can understand it. Because the strategy focuses on liquidity, and liquidity is something that you should have that power to spot it. Because without you spotting the liquidity, it's likely that the market will treat you as the liquidity. If you can know from the famous quotes of many traders, if you're not the liquidity, if you cannot spot the liquidity, you are the liquidity. Some say your stop loss is my entry. So where most people put their stop loss, the market usually take that point as the liquidity. So the strategy is going to be helpful. This approach is going to make you understand a lot of things. I would love to make a proper video and a longer video explaining everything bit by bit. So I would love to have your feedback on this video, and thank you for everything.